On-site coverage of the Precious Metals Summit is brought to you by Borealis Mining.
Hello, welcome back. We're at Beaver Creek and I'm with Adrian Day, CEO of Adrian Day Asset Management and the fund manager over at Euro Pacific Gold Fund. Adrian, good to be with you.
Well, thank you for asking me, Peter.
Obviously, we caught up in March during PDAC. What's your view on how things have changed since March?
Well, obviously, you can tell by the smile on my face. Obviously, it's good. I think some of the things that we were talking about there, not just we, but people have been talking about, are finally beginning to play out. Because the big theme back in March, or my big theme back in March, I should say, not speaking for everyone, but the big theme there was, okay, gold is obviously doing well because of central banks, because of non-official Chinese buying and other sources, but the North American investor just isn't in the market, and because of that, the gold stocks are lagging. And we're beginning to see that narrative is definitely shifting. Now, we might come to it later. I still think that the gold stocks, even though this year, the last 6 months, they've had leverage over gold, the leverage is still less than you typically have. For example, if you look at gold over the last, 2 years, 18 months, it's gone up 40%. The last time gold went up 40%, the gold stocks were up 3.5 times that. This time they're up, 1.5 or 2 times. Yeah. So I'm certainly not complaining about the gold stocks being up 70 and 80% this year, but it's still, they're still not giving us the leverage that we're used to. And there's reasons for that, because North Americans, and we'll get into this, I'm sure, North Americans are only just beginning to get into this market. That's the important thing.
Do you think the delay in getting into it is just because of the level of uncertainty? No one really knows what they should be doing with their money in a way. Obviously we were talking a lot about tariffs as well back in March. We had that huge trade war going on between Canada and the United States. You roll forward to now. I just wonder how much of where we are geopolitically is now one of the bigger drivers. We saw even last week the Chinese military parade. I feel like that shocked a few people into maybe thinking worst case scenario on a few of these things.
Oh, absolutely. And of course, India joining with Putin, Modi with Putin.
That's unsettling.
That's another, forget about North Korea, but although they do have a nuclear weapon, maybe. But so a couple of things there, if I may. First of all, when you talk about tariffs, and I think you were alluding to the uncertainty this year since Trump came in office. I think we must realize that the gold move and the lack of interest from North America, that's something that's been going on for the last couple of years. So it's not just something that's brand new since the uncertainty with Trump. I think it relates, it's not totally illogical, because I think it relates mostly to who's buying and why they're buying. Central banks, as we know, are buying to diversify their assets away from the dollar in the face of dollar weaponization. And if that's if that's who you are and that's your motive, you might just buy a tiny bit of silver. But basically, you're going to buy gold bullion. You're not going to buy gold stocks. And the same goes if you're a non-official Chinese investor. You want bullion if you're trying to protect yourself against a possible devaluation of a yuan, and you're going to want gold bullion. You're not going to want, Newmont, let alone Ajax Exploration. And so it's not illogical that when you think of who's been buying and the reasons they've been buying, it's not illogical that they're buying gold bullion and not buying stocks. When do North Americans typically get interested in gold assets? It's when the economy is conducive to gold assets, which means a weaker economy, low and declining interest rates, high and rising inflation, and a declining dollar, US dollar. And when you look at it, until really the last couple of months, other than the dollar, which obviously had a big drop this year, but even going on a tangent, even with the dollar, if you look back 5 years, it's still high. But forget the dollar for a second. But the narrative on the economy, on interest rates, on inflation, was simply not conducive to gold investments. But now, and I talk about the narrative because I thought the economy was weaker than the headlines would suggest. But, you know, it's not what I think, it's what most people think. But now that narrative is definitely changing. I mean, with the jobs numbers we've had now, new jobs and continuing claims and new claims, with the whole jobs reports we've had for the last, 2 months, even the biggest bull on the economy has to see the growth is slowing at the minimum. And now, of course, the Fed is almost certainly going to cut rates. Mm-hmm. Is it next week? 2 weeks?
I think it's September 16th.
2 weeks.
Yeah.
I don't even know what day it is. Oh, today's the 9th. The 9th. So it is next week.
Yep.
Okay.
Yep.
So the Fed is cutting rates, and you look at inflation. Yeah, it's not running away, but it's inching up. You look at the producer price numbers, as well as the CPI numbers, and they're inching up. And so the narrative, and the dollar's had a very mediocre bounce. I mean, from when you have a first half decline that is the largest first half decline since 1973, and the bounce they had in the middle of July, that's the biggest you can manage. That's not a good signal. So I think the narrative on all of those economic factors is changing to an economy that is more conducive towards North Americans being invested. And that's the way, that's my framework that I'm looking at this. And then, I'm sorry, you did ask, or you did mention geopolitical. I think a lot depends what we mean by geopolitical. If we typically, if you go back over 50 years, I've done studies, a little pretentious, but I've done
some research.
Some research on this. You go back over 50 years and you look at geopolitical events, and of course, in retrospect, we know what was important, what wasn't important. But at the time, you don't know. Remember the bombings on the Spanish Tube and the London bus bombing. There was a lot of concern about whether you were going to get a whole series of these. Anyway, my point is, if you look back at geopolitical events, and most of those would be wars or near wars or terrorism, typically the impact on gold is very, very short-lived.
But have we been in maybe since the Cold War, but have we actually been in an environment like this, really, where you have obviously a war in Europe, you have a war in the Middle East, you have a changing of the dynamic in terms of shifting of power, where it's perceived now that China is sort of the emerging power. And something that gets thrown around quite a lot is that you traditionally throughout I think it dates back to ancient Sparta and Athens, was that whenever a smaller country looks like or a smaller power looks like it's going to overtake another one, it's inevitable that conflict is arising. I just think everything that's happening around the world, plus the economic disasters that we're seeing in terms of the deficits and the GDP to debt ratios on top of it, it just feels like this whole big mixing pot of...
I agree with you, and that's why I was going to say, if you look at geopolitical events in terms of wars and terrorism, I don't think that has a huge lasting impact on the price of gold. I mean, typically Russia's a good example of a Russian invasion of Ukraine, where gold moved up ahead quite dramatically as they massed the troops on the border and everything else. The day the troops went in was the peak. And 6 weeks later, gold was back to where it was 6 weeks before the invasion. And you look back, even if you look back at, say, 9/11, which of course was the dawn of the gold bull market of the 2000s, but gold had a spike on 9/11, and then it sort of retreated. There were factors there with the stock market being closed, of course. So if people wanted liquidity, they couldn't get it from stocks.
From stocks, so they could buy gold.
So there were other factors. But of course, gold went up afterwards. But I'm arguing it wasn't because of 9/11 or the fallout from 9/11, or the invasion of Iraq is another example. These things have all been short-lived. But, and here's the Kim Kardashian, the big but. You're absolutely right. So that's when you're talking about geopolitical in terms of wars and terrorism. But when you're looking at changes in really the whole global monetary system, because that's what you're talking about going back to Sparta and Athens, it's who's the dominant power. Yeah, I think more and more people are realizing that whether it comes slowly or rapidly, and I always think people are expecting major changes like that to happen, faster than they typically do happen. But to me, it's a little bit like that overused phrase of Hemingway, how do you go bankrupt? Slowly at first, then suddenly. And, that's all at once, sorry. And then that's how I think we're going to see this play out. The US is still the dominant power militarily. It's still the dominant economic power. It's still the dominant political power. And it's still, the US dollar is still the world's major primary reserve current asset and primary trading asset. But when you look at how quickly those areas have been eroded, I think we're moving towards not necessarily where China replaces the US, but people have talked about a bipolar world. This isn't, I'm not the first one to come up with that. And in fact, a lot of the people surrounding the Trump administration, not necessarily in it, but it was in Mirren's paper back in November before the election, the Mar-a-Lago Accord,
yeah.
But it's also Steve Bannon, who's not in the administration, but likes to say that he has influence in the administration. I don't know how true that is. But a lot of people around the administration and think tanks and everything else are talking about, hey, a bipolar world is fine. The US has its sphere of influence, which is, its hemisphere, and friendly nations.
Yep.
And those friendly nations we will give tariff preferences to. We will defend those countries. We will pay for some defense. And they have access to our markets. And then there's another sphere of influence, which is China. And we don't really care whether those countries have access to our markets or not. Yep. But we're certainly not going to defend them or pay to protect them, which incidentally raises a big question on Taiwan, but that's a totally different issue. And so I think there's that big dynamic. I'm sorry, I'm going off tangent. There's a big dynamic where you don't necessarily have to have someone else replace the US, because that was always a big thing people would say. Yeah. When you talked about things like this, they'd always say, yeah, but who's going to replace the US? Maybe no one replaces the US in the near term. Maybe we move to a bipolar world, but people are seeing that, and that has lots of implications. One of the implications, of course, is that the dollar loses its influence or its power within as a reserve asset, and gold becomes a much more important reserve asset, both for the West and for the East.
Well, I think that's right, and I think that's a big reason why, on top of obviously removing Russia from the SWIFT trading system and whatnot, and weaponizing the dollar. But I think if you listen to BRICS summits, if they're now supposedly there'll be around 40% of the world's global economy, the BRICS nations.
Yeah,
they have time and time again talked about the relevance of gold in any new monetary theory that they may eventually come up with. So I think it is more than just trying to have a safer side to your balance sheet versus the dollar. Surely.
Oh, absolutely. Yeah. But it's also, I mean, when you look at the dominance of the dollar in central bank reserves, let's say at the beginning of this century, we were at like 75, 78, almost 80% of foreign reserve assets of all central banks was the dollar. Yep. By foreign, we mean if I'm the Bank of England, we're not counting pounds. Yeah. So everything else I hold. Well, that is extraordinary concentration. Forget whether it's the dollar or gold or Trump forget all of that stuff. That is just extraordinary concentration to have 80% of your reserve assets in one currency, in one asset. If I did that in my fund, the S&C would be all over me. Yeah. But and so I think when this is, and again, I know we mentioned this I'm sure we mentioned this in March. This is not something that just started this year with the current president. This has been a trend that's been going on for a long time, again, very slowly at first. So we went from, 75, let's just say 75% of foreign reserve assets in the year 1999. 5 years ago, probably 65%. Yeah. Well, for institutions like central banks that are so slow moving typically, that is a huge decline, especially when during those years, they were actually earning increased number of dollars. Yeah. So to reduce it was pretty astonishing. And then of course, what were we down to when Trump came in? We were at the end of last year, we were probably down to 55%.
Yeah, I think I saw a figure recently. I think it was around 52%, something like that. Yeah.
Yeah, the last number I saw was actually 47%, and it came from the ECB. But I don't know.
I mean, that's crazy though.
I don't know if you can trust those people.
Yeah.
Foreigners, French as well. But I'm saying but you can see how it's accelerated, but to go from 75 to 65, 65 to 55, and then from 55, as you say, to 52 a few months ago, now to 47.5%, that's a dramatic shift. But so it's, to me, it's, even if you take away the weaponization of the dollar, which again has predated the current administration, been going on for a long time. But even if you take that away, it just is prudent to diversify. Yeah. And that's just added the extra impetus. Now, when does it stop? That's a big question.
Well, that's actually what I was going to ask you next, is almost this forward outlook. I wonder if you have thought about what the next 12 months, 24 months or so looks like.
Well, as you know, yeah, I mean, I think central banks are still the dominant, so let's start there. Now, obviously, if you've got 47% of your assets in the dollar, and obviously it's more for some and lower for others, but if you've got on average less than half, well, the urgency is not as much as it was when you had 75%. But if the weaponization of the dollar is something that really concerns you, what's too much? I mean, it could be zero is the right number if you're really worried about them stealing your assets. Russia obviously has no US dollars, and they got out of US debt, years ago, 5 years ago. So for some countries, you need to be significantly below basically half your assets in the dollar. The World Gold Council just did a survey of central banks, you probably saw it, asking what they would be doing, and a significant majority said that they would be increasing their gold over the next 12 months. And I don't think was there anyone on that list that said they expected to reduce them?
Well, I mean, why would you?
So I do think the central banks are going to continue to be buyers. We're clearly now, with the economic shift and with the geopolitical shift, you've got added impetus, which is becoming apparent to people, yeah. Right? That's the thing, is not whether people like you and I and the intelligent people that is your audience know about something. The important thing is it a dominant theme?
Yeah, yeah.
And I think that the shift in assets, global reserve assets, has become a dominant theme now that investors are paying attention to, and wealthy people are paying attention to. And of course, it's not just for central banks, as we mentioned, but it's the Basel III, meaning that gold is a primary asset, So there's a lot of things that are just bringing gold back into a role in the world's monetary system.
Hi, I'm Kelly Malcolm, founder and CEO of Borealis Mining. We're reigniting gold production in Nevada, one of the world's most attractive mining jurisdictions. Our flagship Borealis project is 100% owned and fully equipped for production today, with power, water, workforce, permits, and even a modern ADR facility already in place. We've started crushing high-grade stockpiles, and our first gold pour is just around the corner. Historically, Borealis produced over 600,000 ounces of gold, yet much of our 21 square mile land package remains unexplored. with nearly 2 million ounces of historical resources and past drill results up to 67 meters at 16 grams per ton. The upside here is tremendous. But Borealis is just the beginning. Through acquisitions like our nearby Sandman project, with a strong PEA showing 35,000 to 40,000 ounces per annum and $121 million NPV at $1,800 gold, we're building a hub and spoke model designed to deliver scale and efficiency. Our vision is bold: to grow into a greater than 100,000 ounce per year Nevada powerhouse within the next 5 years. With a proven team, strong shareholder support, including mining legends Rob McEwen and Eric Sprott as major backers, and multiple catalysts ahead, we're positioned for both near-term cash flow and long-term growth. Follow our journey at borealismining.com or connect with us at info@borealismining.com.
Do you think as well, like you look at rumours at the moment of France and the UK potentially needing a bailout from the IMF. You look at, like again, well, I mentioned it earlier, but the sheer deficits that we're seeing in the US year on year that only seem to be increasing, and then obviously the overall debt amounts. It just appears, as well as this wider thematic of central banks and whatnot, that there just isn't enough. There isn't a lot of faith in Western governments that they're actually really going to be able to sort out their economic crisis.
Oh, absolutely, no question about that. France, of course, has sort of been in a decline really since Mitterrand. Yeah. I mean, they've never really, they've been in a position of economic decline. What is that now? 30 years?
Yeah, it must be. Yeah.
And with that goes a sort of waning influence. I don't think anyone, except for French, think that they are still a sort of global, dominant diplomatic power. Obviously, Germany has overtaken. Well, they don't seem to play much of a role globally and diplomatically, no. But certainly on the economic front and the political front, domestic, within Europe. But even Germany's got its problems. Britain's economy has been, pretty much stagnant for, again, 25 years.
Yeah.
Yeah.
And it's also just the cost of borrowing that we're seeing in these countries as well. I mean, you look at France, like their cost of borrowing is now higher than Greece. I feel like we're really getting into a point now where, like we said, we've got this wider thematic around gold purchasing and the role of gold. But I think for me, it's not so much it is also the emergence of these other nations and this power struggle, but just the sheer lack of competence within Western governments to get a grip of things.
Oh, no, absolutely. And, as you say, you've sort of given them one chance after another, and every one has sort of failed. Yeah. Oh, is Boris our savior? Oh, maybe Rishi, who's just...
But I feel like COVID has sort of shone a light on that and almost expedited that process of people being worried, because you saw the amount of quantity of easing, you saw the amount of money printing, you saw the deficits go up more and more. I feel like that's now really just sped up by maybe a few years what was already going to happen.
No question about that. Yeah. No question about that. And the other thing, of course, not to be too political, but it's certainly true in the US, and I think it's true in Britain as well. But a lot of those sort of you had the huge increase in let's call it helicopter money during COVID, and those things haven't just been clawed back.
Yeah.
You never claw it back. And so, no, absolutely. I mean, the government is still, not for COVID, but there's, the programs that are being handed out, the free money, is still very, very real. And politically, it's difficult to claw things back once you've given them.
Yeah, exactly.
So that did accelerate it, but it was underway anyway, as you say.
How are you looking at, I just want to go on to actually more of the investing side of things, of course. With your funds at the moment, and I guess even if obviously you might have your own restrictions on funds in terms of what you want to buy, but where are we in the cycle at the moment? Is it still producer dominant? Are we still looking at those, or is it now time to start looking a bit more downstream?
Yeah, no, well, both. Yes and yes. I mean, I still think the senior stocks typically, not necessarily every single one of them, but the senior stocks typically are still good values with a lot of, and we're just talking stock price, not company, but stock price appreciation ahead of them. And I say that for two reasons. One is, even though the gold stocks have moved up significantly this year, the U.S. investor, the ordinary investor, the dentist in Oklahoma, or the registered investment advisor that knows nothing about it but is saying, I think we ought to have 2% in gold, or he's getting calls from clients. Yeah. These people have only just turned. They've only just started to turn, and you can, towards gold, and you can see that very, very clearly in the flows into the GDX and the GDXJ. Until the last week of August, right? So all the way up to the middle of August, third week of August, you had massive and continuing outflows from the GDX. I mean, just think about that for a second. The gold stocks are up 50, 60, 70%. Gold's at pretty much new all-time highs. The world's falling apart. But the GDX is seeing massive outflows. So as of last week, when I left the office, I don't know about today, but as of last week, you'd had 2 weeks of inflows into the GDX, amounting to about 300 million. And year to date, you've still lost 3.5 billion. Year to date, you've lost 3.5 billion in outflows from the GDX, which, when you think about it, is just mind-boggling.
It is, yeah.
And so again, I take that as an indication that the ordinary investor who's not a gold bug is only just turning towards gold. Now, 1 week, 2 weeks doesn't, one swallow doesn't make a spring or summer, right? Yeah. But it's certainly a change in direction, and a significant change in direction. So that's number one. Oh, and sorry, when the dentist in Oklahoma calls his registered investment advisor who knows nothing about gold and says, I think we should have some exposure to gold, what does the guy do? Well, he doesn't buy Ajax Exploration.
Yeah, he buys Barrick or Newmont
he buys
or
Barrick
the GDX.
Or Newmont or GDX, yeah. And so I think the stocks are still going to continue to get inflows. We haven't reached a point where everyone's invested and now they're buying more, and the more is going down market. Down the food chain, maybe is a better way of putting it. Down market sounds but the other factor, frankly, is that the stocks are not overpriced. I mean, I remember periods in the past when we've got inflows coming in, and I say, oh my gosh, I can't buy Newmont at this valuation. Oh my gosh, I can't buy this at this valuation. That is not the case today. Yeah. You look at Agnico, Agnico's a good example because it's a nice, clean company with nobody can say, oh, well, that's because they're in Mali. Oh, that's because they're building something in Pakistan, for goodness sake. Yeah. So you look at Agnico, good jurisdiction, strong balance sheet, deep pipeline, great mines, and it is still selling in the lowest 20 percentile of its price to cash flow in its 40-year history. Wow. If you look at their price to cash flow today, it's higher than last year, but it is lower than every single one of the last 5 years. So it's not overvalued. And you could do that exercise with, net present value and everything else. Now, I'm not suggesting the stocks are as cheap today as value. I'm talking value, not price. They're not as undervalued today as they were in January. But they're not as overvalued. They're not as overvalued as you would think, given the increase in the price of gold, because not only has the price moved up, but the thing we're measuring price against has also moved up. As the price of gold goes up, the net present value moves up, and the value of the mines goes up. As the price of gold moves up, the cash flow moves up. Right? So, no, the valuations are still very cheap. So, I mean, I think that big cap stocks are still going to, I don't think anyone's missed that. They're still got a lot ahead of them.
Okay, and what about on the junior side? I think one of the main theories is that until you start really seeing a flurry of M&A, that these stocks there aren't really going to be much excitement in the junior side, so the exploration stocks or the early development stocks.
Yeah.
Are you now getting sort of starting to take a punt on some of these guys, or have you been already?
No, we've been in the juniors probably for a few years. We had too much too early, to be honest, but we probably got more in the junior, in the exploration than most funds. I mean, we are beginning to see some of that M&A.
Yeah.
And the stocks are beginning to move. The GDXJ, of course, they call it the GDX Junior, but they're not junior, right?
No.
Pan American and Harmony and
May as well call it the GDX mid-tier or something.
yeah. but when you look at the exploration index, for example, looking at the S&P, TSE, whatever they call it, they need a catchy name for it. But that's barely budged this year. So what you're seeing is that certain stocks have done very well. They've done well with results. They've done well with acquisitions. They've done well on news, but the mass of them have not done particularly well yet.
I think that's right, though, in a way, in terms of, I think just throwing money at the junior sector without sort of proof that they can actually deliver and can actually sort of get results is not a good thing. And that's always been a bit of a bugbear of mine with flow through in Canada, is that it almost turns into a reward mechanism for companies that potentially otherwise wouldn't already have.
You and I may be two of the only people on the planet, but I do get tomatoes thrown at me in Canada when I say I think it's too easy.
Yeah.
In Canada to raise money.
Yeah.
It's too easy.
Yeah, I agree.
Because it means all the garbage can raise money. And the money that the garbage, it's a serious point here, the money that the garbage raises and wastes is money that didn't go to good, hardworking companies putting money in the ground.
Yeah, I agree.
So I think it's too easy to make money. But yeah, so that sector's beginning to move. I think people should definitely be looking at the exploration stocks. You're right. M&A is what really gets that sector moving. And the M&A we've had in the industry so far, I mean, it's been really quite active. I mean, from Newcrest being taken over by Newmont and Yamana being taken over by Agnico and Pan American, and then Pan American buying Mag Silver. There's been a lot of M&A, whether it's two big caps merging.
I think that's what we've seen a lot of, isn't it? It's more of the bigger guys sort of consolidate.
But we're also seeing B2 bought, I've forgotten the name, Goose Bay. Who owned Goose Bay?
Oh, it was...
that one.
Was it Sabania?
Sabania, yeah. Sorry, because they've gone, I've forgotten the name. There's only so much I can hold up
It was Bruce
here.
McLeod's
Bruce
company,
McLeod,
wasn't it? Yeah.
But you saw that. You saw
Equinox of obviously
Equinox and Calibri.
Yeah.
So we're seeing mergers of big ones. We're seeing takeovers for specific assets. Like B2 was obviously for buying Sabina was for a specific asset. What we haven't really seen yet. We've seen a lot of that increasingly. What we haven't really seen is the real junior. We haven't seen a lot, I should say, of the real juniors just get taken over. Yeah. The exploration companies, but that will come, and there are companies making, like Agnico Eagle, for example. They have a portfolio of investments in junior companies that's over $1 billion.
Right.
Yeah, it was interesting. Their last conference call was really interesting on that, because that's a huge amount of money. And Amara Al-Jud, the CEO, made it plain, this is not an investment fund. We're not buying these companies to make money out of our stock investments. Yeah. So when we looked at it and decided the project is not for us, we are going to look to sell. Well, so if that's really true, now, of course, they can't say, no, we're not going to buy that asset, let's dump the stock. Yeah. But if that's true, that's $1 billion worth in stocks that they're thinking of
potentially taking over down the line. Yeah.
That's a staggering, or that they're looking at with that view. Now, they did just sell a big block, which was their largest holding, I think, in Orla. Because that one's done so. I mean, part of $1 billion is for growth, of course.
Yeah. Well, look, I think they own 14% of Rupert Resources. That's $1 billion.
Of which one?
Rupert Resources. That's like billion plus
Well,
market
that's
cap now as well.
potentially strategic, I think.
Oh,
though. Yeah, of course.
I think so.
But they've decided they're not buying Orla, and I mean, Orla's doing very well, of course, but they invested in Orla for a property in Panama. But if you talk to Orla today, they don't even mention it.
Yeah.
And so it made sense. I don't know what price Agnico paid, but they obviously have a big gain on that. Yeah. So it made sense to say, well, we're not doing that. We don't need to own Orla anymore. The point I'm making is that $1 billion is not an investment fund of good companies.
No, so it does sort of highlight that it is in process. These guys are looking, they are getting themselves ready and positioned to when the time's right.
And it's the big companies. I tell you what's really interesting to me is that with a lot of them, it's the big companies that are doing alliances and options and strategic placements, rather than sort of the mid-tiers that might be perhaps a little more aggressive in taking over quickly. Just two quick examples. I've just had a meeting with Origin, and I'm having a meeting with Midland tomorrow. They just walked by. So you look at those companies, Origin, small company, 100 million market cap. They've got alliances with BHP, South 32, Triple Flag, and Altius. Altius, billion-dollar company, but the others, multi-billion-dollar companies, all good, solid companies that have given given Origin money to look for projects. You look at Midland, they've got alliances or option earnings with BHP, Rio Tinto, Barrick, Cisco, Agnico, Soquem.
Blimey.
So, I mean, these big companies are looking, right? But of course, the big companies, take time. And the thing we have to realize with, as investors, the thing we have to realize with the big companies when they're looking to acquire something, they don't look to do it when the stock is the cheapest. I mean, you could talk to 100 juniors and they're all saying, oh, Agnico's going to take us over. Oh, Newmont's going to take us over. Look, we're right next door.
Yeah, I heard that before,
Yeah. But the senior, first of all, wants the junior to de-risk the project. They want to do all the community relations. They want to do all the permitting. They want them to de-risk the project. So that's the first thing. And they would rather, literally, pay 3, 4, 5 times as much for a de-risk project than buy it on the cheap when it's still not certain. And the other thing is that's important that people don't always focus on, frankly. People think about that, but they don't always focus on the senior will buy the junior when the time is right for the senior. If they've got 3 projects that they've just acquired and they're developing, they don't want to buy another one.
Yep. Well, we saw that with B2, right? Well, they weren't doing a lot of activity while they were building Goose, and
when
now
the
they
mill feed goes down, then you will buy the mill. Then you'll buy the other project to increase your mill, to replenish your mill feed. So it's a matter of when is the time right for them.
Yeah, and I think we saw that with like Agnico in the Malartic region. They're now starting to. I think they bought out O3 because obviously they're looking a bit further forward, but with capacity there. Yeah, so it is starting to happen. I think these companies are now starting to plan a little bit further forward of replacing reserves, replacing ounces.
Sure.
It is there, yeah.
And yet we haven't seen, I mean, you could argue, oh, that was a bit of a head scratcher, or I wouldn't have done it. But we haven't seen stupid acquisitions. I don't think. Name one, I don't know. Maybe there's some. But I mean, you remember back in 2011-12, there were stupid acquisitions. There were head scratchers. What are they thinking of? What are they smoking? And, grossly overpaying for marginal assets.
Yeah.
And in fact, John Tommaso I think it was John Tommaso, I shouldn't say it because it may not, I'm pretty sure it was him. He did a study, and within 3 years of 2012, 75% of the money that had been spent on acquisitions had been written off.
Wow.
Written off, not written down, written off.
Yeah.
We're not seeing that at this point. We've seen 1 or 2, which I won't mention because that wouldn't be fair. But we're not seeing that. We're not seeing that at this point. The mergers and the acquisitions, whether they work out, whether they're not as good as we thought they were going to be, whether they paid a little more than we wish, whatever. They're not stupid. They all make sense.
Yeah, and I think also just in general, the mining company, the senior mining companies, if anything, they're sort of getting rid of their second tier assets. You sort of see they've probably learned from that experience, right? Where you sort of want to focus on sort of high margin, sort of long life assets rather than sort of taking up bandwidth in other areas.
Sure.
Just to finish up, say for example we're sitting here again this time next year, where do you think we're going to be with the gold price and where we're going to be in terms of the junior and even the mining equity market?
Well, you know what they say, if you predict a price, don't predict a time.
Yeah.
And you tell me a time, so I'm not going to be...
Okay.
I definitely think we're going to be higher. That's a simple one. You know, how high, an awful lot depends on how this big geopolitical monetary reset, you know, how rapidly that goes. But, you know, I mean, my gosh, we could easily be knocking on 5,000.
Yeah, I wouldn't be surprised.
Yeah,
at this
easily.
point. Yeah.
But I mean, the stocks, let's not forget, let's say gold goes to, you say 4,000, it sounds
But this is
so conservative.
No, but it's $400 away now. Less. It's $350 away now.
Let's say gold goes to 4,500, you know. Well, at that price for gold stocks are going to be massively higher than they are right now.
Yeah.
Because apart from the increase in the valuation and everything else, that sort of price is just going to get more and more investors interested
the cash flow
in the
coming out
sector.
of these companies at that price as
So
well.
you see gold at 45 to 5,000, and you're going to see all the seniors are going to be easily double where they are now.
You know, 5 years ago, I used to see people on different shows calling for $5,000 gold back when gold was, you know, 1,600 or whatever. I used to thought they were insane. It's not looking so insane anymore.
No. Well, no, absolutely.
Yeah. All right.
Absolutely.
Well, Adrian, I really appreciate your time.
No,
Thank you.
Thank you so much, Peter. Thank you.